You open your banking app, look at your balance, and everything still looks normal. But right underneath, a news article pops up. Shares of Bank X fall 30% in one day. Liquidity rumors. Bank reassures customers, we are safe. You scroll down to the comments. Some people shout fake news. Some scream withdraw now. Others brag they've just moved everything to another bank. You hesitate, your finger hovering. But you leave the money where it is, because if it were serious, the government would say something. No official announcement means it's fine. Is that really true? Or have people with more money and better information than you already run through an entire silent script? A private playbook, long before that headline ever hit your screen. This video is called The Bank Run Playbook, What Elites Do Before You Hear the News. Because we are going to strip it down step by step. When a bank starts to have real problems, who finds out first? What do they do first? And why? By the time you hear about it and line up at the branch, the game is already almost over. Before we talk about the elite playbook, we need to understand one brutally simple thing. Banks do not keep your money in a vault like in the movies. You deposit 100, they don't lock 100 in a steel box waiting for you to come back. They keep a small portion and use the rest for long-term loans and investments. Mortgages, business loans, bonds, government debt. That's the fractional reserve model. Customer deposits plus bank capital. Long-term illiquid assets. As long as you, me, and millions of others don't all ask for our money at the same time, that model works fine, even brilliantly. But if a large enough percentage of depositors start to worry and demand their cash, the bank has to do something very hard, very fast. Turn long-term, hard-to-sell assets into cash. That's when a bank run turns into a nightmare. What most people don't realize is, a bank run almost never starts with people queuing in front of branches. It starts quietly, in Excel files, in risk reports, in phone calls between big company treasurers and the bank's corporate relationship managers. In other words, the elite run, the run by those with large balances and good information, usually comes before the public run by days, weeks, sometimes months. And their playbook is almost always the same, whether it's 1930 or 2023. Go back to the United States in the 1930s, during the Great Depression. You've seen the black and white photos, long lines of people outside banks, clutching passbooks, faces tense. That's the dramatic part of a bank run. But what about the opening act? That began in boardrooms, when bank management realized the value of their farm loans, real estate loans, stock holdings was dropping fast while withdrawals were ticking up. Then came closed-door meetings with local tycoons, the central bank, and politicians. Some wealthy depositors with direct lines to the board got a gentle hint. If you want to be cautious, you might want to spread some of your deposits around. Experienced business people saw the numbers and understood immediately. When a bank is asking urgently for emergency support, the fire is already burning under the floor, even if there's no smoke upstairs yet. Jump to something more recent. Northern Rock in the UK in 2007. It gave us one of the most famous modern bank run images, people lining up outside branches for the first time in decades. But weeks before TV cameras filmed that, there had already been a silent run. Other banks had started limiting how much they lent to Northern Rock on the interbank market. Money market funds and institutional investors cut their exposure. Corporate clients quietly shifted deposits to stronger banks. They didn't wait for the BBC. They had credit ratings, bond market spreads, and direct lines to the bank's relationship managers. By the time you heard Northern Rock is having liquidity issues, but everything is under control, most of the big smart money had already left the ship a few stops ago. Or, take Silicon Valley Bank, SVB, in 2023. The media story said, on one crazy Thursday, customers pulled $42 billion in 24 hours. The speed was unprecedented, yes, but look at what happened before that Thursday. For weeks and months, big VC funds and startups with professional finance teams had already seen the signals. SVB's huge bond portfolio, sitting on massive unrealized losses due to rising interest rates, a customer base heavily concentrated in cash-burning startups dependent on new funding, the share price sliding. Some had quietly started reducing balances, moving cash to bigger banks, buying short-term treasuries. Private Slack groups, CFO VC banker calls, had discussed SVB risk long before the panic hit Twitter. By the time the viral tweet sparked the public stampede, the elite playbook was almost done. Much of the easiest to move money had already gone. So what exactly is this bank run playbook that the wealthy and well-informed tend to use? Let's break it down. Step 1. Early information and internal signals. This is the zone where ordinary depositors are almost blind. Bank executives, risk managers, and regulators see things you don't. Daily withdrawal patterns, unusual spikes in outflows, the cost of borrowing overnight money on the interbank market jumping, credit spreads blowing out on the bank's bonds, internal non-performing loan ratios, stress test scenarios showing if another X% of deposits leave, we'll have to sell assets at a loss. These numbers live on Bloomberg screens and in internal reports. When risk crosses certain thresholds, the first people to know are not you. It's them. Step 2. Soothing words and PR. It sounds counterintuitive, but the moment you start seeing a bank repeatedly on the news saying, "We are very safe, our liquidity is strong, our capital position is solid," things are already tense inside. You almost never see a truly healthy bank constantly repeating, "We have no problems." Reassuring statements are not proof of crisis, but historically, many stories follow this pattern. Silence, then sudden waves of reassurance, then the blow-up. At this stage, elites play a double game. To the public, they push out messages like, "Everything is fine, don't worry." To large clients, the conversation is subtler. "We are sound, but if you want to be extra prudent, you could diversify some funds." No need to panic, of course. Step 3. The quiet run of big money. This is the heart of the playbook. Corporations, funds, and wealthy individuals with finance teams start acting. They don't line up at branches. They send emails, make calls, tap a few buttons in a corporate banking portal. They reduce their cash concentration at that bank from 100% to 70%, 50%, 30%. They spread money across 2 or 3 other banks, buy more short-term government bills. They don't yank everything in one go. That would be obvious and self-destructive. They withdraw gradually, deliberately. Over a few weeks or months, the most sensitive money, the money of those with information and power, flows out. Step 4. Backroom negotiations. While the big money is slipping away, bank management goes into firefighting mode. They negotiate with the central bank for emergency liquidity lines. They talk to the government and regulators. "If we go down, the shock will be systemic. You need to help." They hunt for a buyer or merger partner. They hire crisis PR advisors and lawyers. All of this happens behind closed doors. What do you, the person with a few thousand or tens of thousands, see? Maybe one short line. "Bank X is working closely with regulators to ensure stable liquidity." Sounds calm. But behind that sentence, there may have been all-night meetings because the balance sheet is already out of room. Step 5. The sudden public announcement. Eventually the game reaches a point where it can't be hidden. News leaks. The stock tanks. Ordinary people get spooked and start calling and queuing. That's when you see the familiar visuals. Long lines at branches, empty ATMs, apps freezing. But at this stage, most of the sensitive money has already fled. The people left are those without information, those who believed the bank and the state won't let depositors lose, or those who simply moved too slowly. There's another version of Step 5, withdrawal limits and temporary closures. Cyprus in 2013, banks stayed shut for days. Deposits above a certain threshold were bailed in. A chunk of large deposits was turned into bank equity, making depositors involuntary shareholders. Greece, during the debt crisis, ATM withdrawals were capped per day. In these scenarios, the Bank Run Playbook, what elites do before you hear the news, becomes painfully concrete. By the time you get the message and rush to the ATM, the rules of the game have already been rewritten. And you don't get to negotiate those rules. You only choose among the limited options they leave you. The people with more options left that table earlier. So do elites have legal privileges, or do they just read signals better? The answer is both. A corporate CFO doesn't get a skip-the-line card at the branch, but they have the direct phone numbers of top bank executives. A large fund can't ban others from withdrawing, but they do have real-time data. Credit default swap, CDS, spreads, ratings reports, liquidity metrics you will never see. They don't even need inside information, though sometimes they have it. They just need to read public data you don't even know exists. And in some countries, the political banking business elite are so intertwined that bad news always flows through the phone number network long before it hits TV. What does all this do to your wallet? First, it exposes a cruel reality. Bank runs are not fair in time. People who know early have days, weeks to move. People who know late have hours, minutes to panic. Second, it reminds you that a bank deposit is not risk-free. It is a loan you make to the bank, wrapped in nice marketing about safety and trust. Modern systems have deposit insurance, lenders of last resort, regulations and backstops, but all have limits, conditions, and small print. To avoid being the last one running in the Bank Run Playbook, you don't need to become a trader or a banking expert. But you do need a few principles and a few red flags. Principle 1. Don't go all in on a single bank just because it's close to home, or state-owned. History has shown that both private and state banks can run into trouble. You don't need 10 accounts, but if all your cash, deposits, and money market funds sit in one institution, you've handed all your bargaining power to them. Principle 2. Know your country's deposit insurance limits. What's the exact amount per person per bank? 50,000, 75,000, 100,000, $250,000? Does that limit apply per account or per person? Local currency only or foreign currency too? If you keep much more than that in a single weak bank, everything above the insured amount is not safe savings. It is you playing bank investor without being paid as such. Wealthy people almost never park the equivalent of millions in one personal account in one bank. They spread across banks, entities, and asset types. Smaller savers should borrow this habit too, not do the opposite. Principle 3. Don't blindly chase high deposit rates. If a small or unknown bank constantly offers rates far above the market, ask yourself, why do they have to buy deposits so expensively? Part of it might be growth strategy, but if it goes on for a long time, it can be a sign they're desperate for liquidity. In many collapses, just before the end, banks go through a period of extremely generous promo rates, like a drowning person frantically grabbing anything that floats. High yields always attract people focused on the short term, but they are also a giant neon sign. Higher risk than normal. As for red flags, there are things ordinary people can still watch, if they bother. The stock price of your bank, if it's listed, suddenly drops hard while the overall market isn't that bad. News that your bank has to raise capital in a hurry, issuing subordinated bonds at very high rates. Headlines mention your bank with phrases like restructuring, special supervision, resolution plan without clear details. That doesn't mean you must shut your account tomorrow morning, but it absolutely means you should stop adding more and strongly consider diversifying. A subtler signal. The bank starts changing terms, fees, and limits in ways that hurt depositors. Higher fees for large cash withdrawals, tighter limits on transfers out, justified vaguely as security. Sudden, unexplained shifts in interest policies. Any one of these changes might be just business optimization, but if they show up together with market concerns, you shouldn't ignore them. You might argue, if everyone gets this cautious, won't our behavior itself cause the bank run? True. Herd psychology can turn a temporarily illiquid bank into a full-blown crisis. But history shows bank runs don't happen because a few thousand small savers read a news article. They happen because the system was already weakened and large flows left long before. Your reaction doesn't create the hole in the balance sheet. It only decides which side of the damage line you stand on. At the personal level, the Bank Run Playbook, What Elites Do Before You Hear the News, isn't an invitation to become the first panicker. It's an invitation to become the person who has a plan before panic even appears. Like knowing where the fire exit is before the building actually catches fire. Some practical steps that normal people can take, without millionaire accounts. If you have a large cash position, split it between 2 or 3 banks, instead of just one. Avoid keeping big amounts above the insured limit in a single institution. For money you must spend soon. Salary, monthly expenses, you can accept more risk. For money you must protect. Emergency fund, education fund, retirement savings. Prioritize the strongest institutions you can access, or even partly move into assets outside the banking system. Short-term government bills, physical gold, etc., depending on local laws and context. If you run a small business, don't keep all payroll and supplier money in a single account at a single bank. A bank run is not just about who loses savings. It can stop you paying salaries on time even if you're profitable on paper. And most importantly, don't switch your brain off just because someone says, it's a state bank, or it's too big to fail. Financial history is full of names once thought too big to fail, that were merged, nationalized, or bailed in. Yes, in many crises, governments will do a lot to protect the system from chaos. But protecting the system is not the same as making every depositor whole, instantly, with no loss. In Cyprus 2013, the system was saved, but large depositors took a hit. In other crises, depositors got their money back, but only after years, and at a much lower real value because of inflation. In the end, the Bank Run Playbook, What Elites Do Before You Hear the News, is a story about gaps. Gaps in information, speed, and choices. You can't turn yourself into the elite just by watching one video. But you can shrink the gap, going from the last to know, to the person skeptical enough not to be asleep. If you stick with this channel, we'll keep walking through other bank run stories. 1907 in the US, when a New York trust's failure nearly took down the system until JP Morgan stepped in. The Asian and Latin American runs. The final days of Lehman Brothers' Washington Mutual Credit Suisse. Each story adds another piece to the playbook. Which signals tend to show up early, who runs first, who gets stuck. Next time you see a bank suddenly everywhere in the media saying, "We are safe, our liquidity is strong," there is no reason to worry. You won't just swallow that whole. You'll ask yourself, if everything is really fine, why do they have to say it this often? Who is already doing what before I see this? And instead of just hoping it'll all be okay, you'll have a clear plan for the more important question. If it's not okay, how do I make sure I'm not the last one running? If you want to keep looking at markets, banks, and even your own accounts through the lens of financial history, not just through marketing slogans, hit subscribe, so that the next time there's a bank run rumor, you won't only hear the noise. You'll also hear the quiet whisper of history in the background. The playbook started long before you heard the alarm.